Surprise sudden stream from a Stockalypse. Yeah, we're getting into earnings season, and I just wanted to do a couple of quick updates here. Today, I wanted to just talk about bank earnings. We had JP Morgan, we had Citigroup. They came through and smashed earnings. In fact, let's take a look at JP Morgan real quick. Estimates were $3.41 a share, and they came in at $4.10 a share, which is quite a decent beat. But it makes sense. We got interest rates going up. We've got an environment where they're going to do a little bit better anyway. Citigroup also came through. Let's see what Citigroup was doing. An estimate of $1.65 a share, and they came out at $2.19 a share, so not bad at all. You can see they're trending up. They've been trending up all day. This is what I was expecting, but I didn't want to buy long options because long options, they haven't been doing as well for me lately. We're making a move and then we're stopping, which is terrible for premium. And options, even though there's like the Black-Scholes model and there are ways to value options, they're not the best because they don't actually tell you what the valuation of the option is going to be. Because it still comes down to the buyers and the sellers putting out the prices that they want. If the sellers don't think that the stock is going to keep going, they're going to dump their options a little bit cheaper. The buyers aren't going to want to pay as much, so they're going to put their bids lower, and it's just not going to give you what you would think. If you think, oh, look at this, the delta's 30, so I'm going to get a $30 move in the option if it goes up $1. Maybe not. You really don't know. And here's the other thing. While the option is moving, the premium is going to be higher. So if you have calls and the stock is going up, the premium is going to be a little bit higher than it will be if it pauses for a bit. Because as soon as it pauses, people think like, oh, okay, the move's over. I'm not going to put as much out there. The premium will still drop, even if the stock is sort of going in your direction sometimes. So it's not just about what the actual value is based on the mathematical equation. It's what people will pay for the option and what they'll sell it for. You can see that since the start of the year, we have hit this wall, this high volume area right here, and we've bounced off of it multiple times. It's a tighter environment than it used to be, so there's not really a reason for it to pass these points, considering number one, money's more expensive. Number two, the job market is slowly cooling. It's still hot. It's a lot hotter than you would expect in a time like this, but it's still cooling. But basically, we're going to run into a wall until conditions open up. So long options are not going to go that far. This is an area where people are going to get scared and they're going to dump their shares. And there are other people that are looking for breakouts. They're willing to buy because they see these things and they see the past. They think, oh yeah, it's going to break above this at some point. And the market is forward looking, so it probably will break above this point before you expect it to, but I don't think that's the case yet because we still haven't gotten a long-term outlook on what rates are going to be. So once we have confirmation that they're not going any higher, because there's still a chance that they could go a lot higher, it depends upon what inflation says. Once we have that information, then we'll know what we can do 6 months down the line, which means if things look good, then the market can move above that point at that point. I don't think that's going to be the case though. I think we're going to stay range bound. I think we're going to have some rejections because we are having some slowing. So now that we've had the rate hikes, we've had some slowing actually start to show up in the numbers. I mean, jobs are coming in slightly cooler. See, it's a very slow process because things are a lot tighter than we would normally expect it to be at this point. Anyway, so I wanted to talk about the bank earnings today. My goal is to hopefully play these next week. Now, I don't like guessing. Premium is not a good thing to hold long right now because of the fact that the market keeps topping. So the reason I say we have to watch this level is because when the market comes up here and it bounces off this area of high volume, that's when the calls start to dip. But here's the other thing too. It's not the end of the world. So the puts, they're also going to do the same thing because we're going to hit this range. We're going to go back and forth between it over and over again like we have been. And once we get to either side of that range, that premium's dead. And it doesn't go to the extreme in either direction, even when it's moving, because people know there's a limit on this. If you think that there's going to be a limit, you're going to trade that way. And most people are doing that because they don't expect the market to go higher. Now, the reason I say what I say is because I'm expecting the same thing. I think that the market, because people think this, is going to stay in this range. We have a lot of economic factors that would tell us it would stay in this range. We have a lot of sentiment factors that would tell us it would stay in this range. But we still have a lot of bullish traders that are willing to go long on options in either direction, which for me is great because my strategy lately has been to sell premium. I'm shorting options premium because I don't think that's where the money is. And the reason I don't think that's where the money is because my long options keep crashing. They keep going down every single time I get something, even when I'm getting a move in my direction, because it's hitting a wall and it's bouncing back off. I've mostly been watching some of these stocks that I feel comfortable shorting puts on. I sold some puts on Beyond Meat out of the money, so I have some space. I'm not letting it go all the way to zero. You know, I don't like to hold short options all the way till expiration because there's kind of no point. Once you get close enough, the premium's going to be so low, it's not worth holding the risk to squeeze out an extra few bucks. If I sell something, a contract that's around like, let's say $100, if I sell it for that and it gets down to like $30 or $40, I'm out. I don't need to get more than that because it'll drop from 100 down to 50 pretty quickly. And then it'll drop from like 50 to 30 relatively quickly. A lot of people like to get out at 50% profit. My philosophy last year was get out at 40% because the options were moving too much, which that kind of an environment to me is when you go long. Last year was a way better time to go long. I mean, but now that we're in this tight little range right here, if you can catch a bounce from one side to the other, that's great. But the problem is, look at how long we stayed down by this range. I mean, this was days, this is weeks right here. If you're seeing right in this area, like, oh, this would be a good place to buy because we came from here to here, we'll probably bounce again. Well, yeah, you would. But you know what happens? You won't do it until this day, and then you'll do it, and you'll get a little bit of a move, and you'll think, all right, here we go, and then it'll come back down, and then you'll just be sitting in this for a while. Or if you see it come down here, maybe you'll buy it here, and it takes a while to move, and then you get a couple of these red days and you get nervous. So I just don't like that. I just don't like going long in an environment like this. I want to go long in an environment where it's like 3 or 4 days to get from here to here. That's what I'm talking about. Like less than a week, I want to be from one level to another. But if it's taking 2-3 weeks to get back to where you think it's going to go, by the time you've waited long enough to come up here, so much premium has been drained from the contract because of theta that it's not worth it. You're probably underwater, which is what was happening over and over again with my long options. I would get like these little gains, or I'd lose a bit of money because I'd be right, but it would take too long to get to the area, and I'd buy in a little too early. Like instead of buying here, I'd probably be buying in like right here. I'd be like, oh, look, it bounced and came back to VWAP. This is where we're going to go. See this nice green day? It's going to be a reversal. Nah, see, that's exactly the kind of thing that would catch me right there. Or maybe, see, this wouldn't be too bad because you could wait a few days and maybe get out right here. But you know what your gain would be from here to here? Very little. Not very much at all. So that's what has been going on with my long contracts. And I thought, you know what? I should just take the other side of the trade. I mean, I usually do a mixture of everything. I like to have some longs. I like to have some shorts. But in this case, every single long was just getting crushed. So I decided to switch, and that's been working really well. Like I sold some puts on First Republic. When that happened a couple of months ago, I was looking at the premiums for First Republic. I mean, look at how high this is that far out of the money. 18 Delta, right? The 18 Delta put is $125 on the high end right now. I mean, that's insane for a stock that's at $12, $13. Usually premium at this level is in the double digits. On a regular stock, this $9 put right here would probably be worth like $50 or something. The premium is extremely elevated because there's high risk in this stock. Now they recovered. The government and the banks kind of came together and did a thing that, upsets a lot of people when they do, and sort of bailed them out a little bit. It's like shadow bailing. I don't know, whatever you want to call it. It's like they bailed them out, but they didn't really do it officially. So they'd be like, no, we didn't do bailout. Because people don't like bailouts after 2008 when everybody got a bailout except, the average person. They're basically protected at this point. There's still risk. Things could fall through. There's always problems. But because there's risk in this company, because they hold so much risk still, the premiums are high because any little thing could happen. If one of those banks that's coming together like throws a wrench in the plan, or the government decides to change their mind, or Yellen comes out and says some stuff like, oh, maybe we won't cover as much as we were, like she did the day that the Fed reported, that could move the stock quite a bit. Like if it went down, that would cause this premium to accelerate. This was $120 something or $150 stock not that long ago. Let me go back to the charts. Look at this. This fell from $120 all the way down to $12, $13. And the reason I sold a put in this a little while ago is because it fell down. It was hanging around 12 here for a week or so. So I would say somewhere in this area. I sold a put at some point, and then it pumped a little bit, and it kind of held there for a while, and I took my gains early because of the risk. I could have waited because, look, it's been flat ever since. I mean, I sold the put when the thing was in the $12 range, and it's in the $13 range now. So I'd be, and the put would have expired next week. So, I mean, I could have held it. But I didn't want to take that risk because even though it's very unlikely that something was going to happen, when something falls from 120, it's still a legit business, and it has the backing of other banks and the government behind it. That's keeping it afloat right there. If none of that happened, they'd be screwed right now. They'd be completely screwed. It looked like a good time to do it because the premiums were so inflated. So yeah, I sold this one right here. I sold the $3, or maybe it's a $3.50. I don't know. It was at $12. I sold the $3 or $4 put. And I collected like well over $100 for that thing because it was so insane. I mean, look at the premiums now. The $4 put is only worth $20 right now. So you can see that people are much less afraid of this dropping to zero than they were a month and a half ago, whatever it was. I ended up selling that, making a good chunk of change on that because there was high danger. And that's when you're selling options, that's what you want. You need danger in order to inflate the premiums to the point to where it's worth it. The reason the premiums inflate is because the people that take the risk by selling these options have to be the ones to cover it if things go to shit completely. So they want to make sure they're getting paid a little bit more to take on that risk. It's the same way with insurance. Like if you go to buy car insurance and you've had 10 accidents, I mean, if you could still get insurance from some places, it's going to be expensive because you're high risk. So they're going to charge you more in premium. It's the same thing with them. This could have crashed easily. So the premium was way over the top. And I thought, man, with making like well over $100 per contract, it was a $3.50 contract, which I sold for $100. My risk would be $250. So the stock could have gone all the way to $2.50, and I would have just broken even at that point. So it would have been, I was protected all the way down. So from 12 to 250, I was protected no matter what. As long as it stayed above that 350 mark when it closed, I could have made all the money. Or as long as it stayed anywhere above that point, I was still making money. Because as time goes on, the premium's going to shrink. Even if the stock came down to $4 and was like touching my put almost, it still would have slowly drained over time because it wasn't passing that threshold and the time premium was being sucked out of it. So this was a great trade for me. I wish I'd sold more. I mean, it was so low risk. Like I said, $250 per contract, that's nothing. You could sell a few of those. And the other thing is I would have had the shares. So let's say that had happened and I got exercised. I mean, if that was the case, then the bank would have been screwed and it probably would have gone well below that. But because it didn't, let's just say it had dipped low enough and I got exercised, it could have bounced, it could have stayed around there, and then I could have sold calls because the call premium was also insane. I mean, if you look at this chart, you can see going from $120 all the way down there means that this range is open to jump back up if something good happens. I mean, it's not going to. It's very unlikely that something like that would happen, but there's still a possibility that it could move somewhere in this range. That's what you have to think of. So the fact that the calls were expensive, because if you were buying the $50 call and thinking like, oh man, this doesn't even have to go to 120. If it went up to 50 or if it went up to 75, or even if it went up to 30 or 40 and you bought the $50 call, that would be worth quite a bit of money, especially with inflated premiums like that. So people were gambling hard on this one, which was actually a good time to sell premium. That's why I did that. All the call buyers got absolutely crushed. The call and the put buyer, everybody's getting crushed. When you see a stock that is flat like this over a long period of time, the option buyers are just completely dead. They've been completely hosed of all their money. So that's why you want to sell in these circumstances. These are the ones I absolutely love. If you're buying long shares, nothing's happening. So you're not in a bad spot, but you're not in a good spot either. If you're buying long options, you're in a terrible spot. You're absolutely annihilated. I mean, buying puts during this time could have been great. So these short little moves right here. So for this like 1 week, this would be the time I would say you could buy a long option on a stock like this because of this massive move. I mean, look at this day right here. This was it. If you saw this and you heard the rumblings and you bought a put that day, you could have just let it go the day after that and you'd be up so much money, it would be insane. Now, that would be a quick trade. And there's this bounce right here, this fake out, this probably killed so many call buyers. This is the kind of thing that hurts the longs because they see this plunge and they know, okay, there's going to be a bounce, which usually there is, but it's not going to be the bounce that you think when it's something systemic. So this wasn't just your regular everyday, oh, they didn't make that much money or whatever. This was a systemic problem. This could have gone well beyond all of these banks, and we didn't know that at the time. So the likelihood of it coming back quickly was very low. Unless we found out that, oh, they actually had these other investments that were, well, if they had the other investments that were fine, then they wouldn't have fallen so low in the first place. So you know that there's a problem here. When the government has to come in and say, hey, we need to do some stuff because this is bad, that's when you know, like, the calls aren't coming back anytime soon. So anyway, this was a great premium sell for me. This came down. It sat there for a while. The government had already said they're going to step in. So I thought, all right, that's everything that I need on my side. I'll take a super low risk position. The $3.50 put is so low that, like I said, even if I got exercised and the thing went to zero, it wasn't a huge risk on my part. Now, the people that were selling puts in this section, they got annihilated. So that's why I say you don't want to sell options when there's huge moves going on. You want to sell options when a big move has happened and then there is a reason, hopefully a news and an economic reason, why it's going to stay where it is. You don't usually get the economic reason along with things, but this is a special case because this actually involves banks. So there was a reason to have economic and news data on there. But the other thing that was great is this ticker was all over Wall Street Bets. They were all about this. Anytime there's a huge movement in any stock, any popular stock, I should say, it's going to be all over things like Wall Street Bets because that's where the gamblers are going. They're looking for this kind of a move. I mean, the gamblers that bought puts on this day or in this little period right here, man, that's the kind of thing that makes you do it over and over again until you lose all your money because you would be so elated. Like, I have never had this big of a move in a stock. I've never bought something and then have the stock fall 100 points or move up 100 points to the destination. Because like when this was at 120, you probably could have found the $80 put at next to nothing. The $60, nobody was even thinking about buying any of these right here. I mean, there's always some people that are selling or buying these because if you're making a spread, you want to reduce your risk. So sometimes you'll buy or sell a put well out of the range that you're looking for just to save some of your capital. And there's probably some YOLOers in there. But most of the time, it's just going to be close to the range that the stock is sitting at, which is why if you bought stuff down here and it moved, I mean, this is where millionaires are made. If you actually had the $40 put somewhere back here, even before this happened, if you just had a few of them and you weren't expecting much, but you did, for whatever reason, you just bought them, like maybe you own some shares and you really wanted to protect yourself or something, but you didn't want to spend the money on the close to the monies, which would end up costing you way too much if nothing moved. So you decided, hey, let's get some really cheap out of the monies just in case. Well, those people were lucky. So the longs that had that, good job on there. But very few people did. It was mostly just hedging when you see something so far out of the money. Like with Tesla in 2020, you could have bought pretty much any. I remember looking at the $1,000 calls when Tesla was sitting in the mid hundreds or something, and like, maybe it'll get up to 1,000, but I don't know when that'll be, and blah blah blah. Well, it did before the split and ended up going to like 2,500 almost, somewhere around there. So I could have bought the 1,000. I could have bought. I don't even think they had calls that high at the time. I think it was topping out somewhere in the mid to low thousands because nobody expected Tesla to go that far. I swear, like every month I have a thought about that. I'm like, man, if I could have bought like $20 worth of these calls anytime in 2020 and I'd be a millionaire. It's like maybe not exactly that much, but still, I could have had a lot of money for very little. But that does not happen very often at all. So I've never had a jump this big on the long side ever work out as far as the premiums go. Okay, so the main thing I wanted to say was now that we have earnings coming up, this is the time that a lot of people will make plays. Well, I'll usually make plays. So the thing I've been looking at right now is banks, because banks are reporting. So we already talked about that. Let's go back to Citigroup. As you can see, Citigroup popped with JP Morgan. I think JP Morgan was the one that really moved everything because this had a level change. I mean, you look at Citigroup, like I keep switching it back and forth, but you look at Citigroup and this kind of bounced around for a little bit before it trended upwards. And as you can see, the market is kind of picking up right now, so that's helping it a little bit. But JP Morgan was definitely the one that moved it along. And the other thing that I like about it is, look at this. It popped up and it's staying above VWAP. See, this is why you use VWAP as a sentiment marker. If you wanted to do something to the upside, it's in your favor. I don't think this would be the time to do it because, look, it's staying in this tight range. But once you see it staying above VWAP, if you're expecting some kind of a move to the upside, you want to have that on your side for a short-term trade. To me, banks are not good day trading vehicles just because they do this. They kind of find their ranges and they settle. There's not big moves, which is why I didn't make any plays. I'm planning on playing some banks next week if certain things happen. As you can see, there was a level change, much stronger than Citigroup, but it's pulling everything else up. And this isn't the only bank that reported well. There were quite a few that every one that I looked at on the calendar tab, they were all above the estimates. So banks are having a good quarter. If every single one so far, even though this is like the first day, if every single one of them is above the estimates by a good amount, that's telling me that the ones that report next week are highly likely to do the same. But the problem is, what happens if everything is already moved? So JP Morgan, Citigroup, and some other ones have reported, but who hasn't? Goldman Sachs, right? They're going next week. But oh look, they jumped too. So you think, okay, well, they jumped. And if they report next week, then the move has basically already happened. So it could move more, but likely it's not going to. Those of us that have been in the market for a while know this. When you're new and you're just looking for gambling, you're like, oh, look, that moved. Maybe it'll move more. Yeah, maybe, but most likely not. That's why the whole sector is tied together with anything. Like social media is a perfect example. If one social media company does well, they all pop. And it's hard to play one of the other ones because the move has mostly already happened. Maybe you can get more, but when I've tried doing that in the past, I would say most of the time, like a good 70 to 80% of the time, you don't get more, or you don't get enough. Like maybe you get more, but you don't get enough to really make anything on it. Sometimes they disappoint because it's always a gamble. So you think, all right, if the move has already happened and they come in and they report and then there's nothing else, how do you profit off of that? Well, if you're a long trader and you're buying shares, it doesn't matter. You just buy shares when the opportunity arises and then you sit on them. But if you're trading options like me, which I'm also doing long, but if you're also trading options like me, then you need to have something that confirms your move, but still have the ability to make money off of it. So what I like to do is I like to see the sector move, and this coming in under VWAP is actually kind of nice. I like that. I don't want it popping over that right now because I don't want it to be excited. So if we have a move down on Monday with the broader market and it pulls these bank stocks down, then I might consider long options. So that's one thing you could do. If you get a downward move before the rest of them report, so they're unfairly pulled down by everything else, then maybe you can think about long options. I might do that. Not on Goldman Sachs though, because Goldman Sachs is an expensive stock. So I'm not buying long options on a gamble, which this would be. It would be a gamble. If the whole sector moves and you're thinking about more, that's a gamble. And I mean, anything is a gamble really, but in this case, it's definitely a gamble if you've already gotten most of the move or all of the move. So my thought is, all right, if it comes down, then I'll think about the long side. But that's not what I'm thinking about mainly. What I am thinking about is when these banks report, if one of them disappoints in some way and it drops while the other ones are either staying up or continuing to go up, then that's an opportunity to sell puts. And that's what I'm looking for next week with this. Probably Bank of America. That's going to be my one. It's a low price stock. It's one that I know it moved well. It moved with, like, look at this. It looks just like JP Morgan, right? Except it's not staying above VWAP. And well, it is now, but JP Morgan stayed above it all day because it's bullish. People are it's already won. It's done for the day. If you traded JP Morgan, you're done for the day. You were finished at 5:30 in the morning. But this one, because it's large, it's one of the largest. If we get a nice drop on Tuesday, then I would look at long options for this, not Goldman Sachs. But if we report and Bank of America somehow disappoints a little bit, and it's nothing really bad. So that's the other caveat. You have to make sure that if they do disappoint in some way, it's nothing systemically bad, like, oh, we actually had these terrible loans that are way worse than we thought, and we're getting fined because of all these different, like Goldman Sachs, right? They're getting fined because of some stupid labeling they did, like 5, 6, 7 years ago or whatever. They didn't label some short trades correctly. And so if you have some stuff like that going on, something new that people don't know about, and it's very bad, then I wouldn't want to sell puts on it because it could continue to go lower. But if it's just like maybe they don't come in quite as much as everyone else did. Let's just say they come in a little, like a close to EPS or at EPS, or maybe even above EPS a little bit, but just not as much as everybody else. So they start going down. That would be when I'd love to sell puts. And with something like Bank of America, if it's not that bad of news, it'll probably go down for the first hour or so of the day, and then you'll usually see a reversal like somewhere around 7:38 in the morning on West Coast time. And then it'll start coming back up, and maybe it won't pass VWAP. So my guess would be, if you were doing a day trade type thing, which I would actually be holding this for longer, let's say they report, it's okay, it's not as good as people expected, so the elation is gone, the stock falls because everybody was hoping for this and didn't get it. So even though it wasn't bad, people were just looking for this, and since they're not getting it, they're going to dump it and try to move to something else, which is then going to cause a panic and cause other people to dump. So they come in, right, they report, it comes down here, 7:38, like right at this time. You can see about 7:45 where my cursor is right there. Then it starts to come around. This is where I would want to be selling puts. Like I want to see a bunch of red, maybe close to an area that was sitting at before, maybe even halfway there. Like I don't even think it would come all the way. That's when I'd be selling puts, and I'd be holding that for a little bit, depending upon what the market's doing. Because the market also has to be on my side. So that's the other caveat. And then when it came up close to VWAP, that's when I would dump it. So yeah, that's what I'd be doing. I'd let it come down for a good hour and a half, sell some puts. If you wanted to buy calls, you could. It's just so not working right now for me. So it's not my thing. I mean, I'm not going to dog you for doing it, but me, I'm not going to do it. So I'd sell some puts, hold on to it, and then dump it right here if I was going to do a day trade. But most likely I'm going to hold it for more than a day because I want to let that premium drain. Usually it takes a couple of days once the big vol crush happens right away, then there's kind of like this slow burn for a bit before it starts to really kind of stall. So I want to give it a couple of days to let that slow burn get through a majority of it and then dump the thing. So that's the plan right now with the banks. I'm selling premium. I'm waiting for a move first, because the other reason I like to wait for the move first is because if you're buying right here, like, yeah, you could have made a bunch of money if you guessed that everything was going to pop up, and this would have actually been a decent time to do that. I was thinking about it all week. I was like, banks probably are going to have a good go this time. Maybe I should do something about it. But I just didn't want to do it because of how crappy longs have been for me recently. So I'm just like, all right, I'd rather let the move happen and then get some confirmation that I know where the range is going to be, then get on the train, because it's not going to be as profitable as buying it right here. Like the people that bought calls here and dumped them already, even if you're holding them and dumped them at the lowest part of the day, you still made a good amount of money on this nice level change. But because I'm not doing that, I like to have the confirmation there, which you can't really do. If you're trying to catch this, you can't like buy, if you see this going on and then you try to buy it right here, look at what happened. It was up, down, up, down, up, down. You're not going to make anything, or very little. And probably what'll happen is you'll think about it, you won't do it, and then when it's struggling right here, you'll see this first little drop and you'll buy it there and think like, all right, here we go. And if you bought it right here, look at where it is. It's like it's really close to that point. So you wouldn't have made a whole bunch of money in that scenario. So I would have just waited and then jumped in when I could. So that's what I'm looking for. I like to have a confirmation. I don't want to have to gamble on it. I just want the likelihood to be higher that it moves the way I want it to move, and not necessarily grab all of the possible money on the table. It's like I'd rather be safe and grab some of the money than take a risk and grab it all, because that doesn't usually work. Usually when you try to grab it all, it doesn't go your way. And look at this. Here's the other thing I like about Bank of America. Look at how far it came down. It's already at the low spot of the range, so this had more potential to go up than down anyway. So that's the other thing I like about it. That's kind of my strategy right now. I'm into selling premium. I'm looking at the banks because they have a chance to move. And I'm going to be looking at some other earnings coming up soon. I'd love to be able to do a little YOLO that's cheap and make some money on it, but we'll see if that actually happens. See, this is a good earnings season to actually think about that, though, even if I'm not doing it, because there's so much negativity right now. The recession talk has gone up so much recently because we're starting to see softer data. So even though we've had recession talk for the past year and a half now, it's just been recession. Even in 2021, when things were still going up, people were talking about recessions because they're always talking about recessions after a big thing like the pandemic happens. But because there's so much more negativity, and because it's very likely that we're not going to keep going higher, there's going to be more people shorting, which means squeezes are very likely in stocks that have the ability to move like that. So meme stocks, those are the ones that could squeeze pretty easily. I mean, you see some of these meme stocks like First Republic, like I said, it became a meme stock because of what was going on with the financial system, but then it stayed a meme stock because people were just trading it so much. They're allowing the premiums to stay inflated. And because of the banking thing, we've got that even beyond Wall Street bets. It's also people that actually know what they're doing that are doing that as well, because they're thinking, hey, this is the time to do that. Although, like I said, I don't really like inflated premium. So there's a good rule of thumb for you. If premium is super inflated for any reason, it's just not a good time to buy. Even if you think it could continue to go, even if it does, it's still not a good time to buy, because not only are you going to have to pay more to get that, you're going to have to try to sell it to people that are not wanting to come up to get you because everything is already overinflated. What'll happen is sometimes people will jump the bid and buy options or stock or whatever above the bid price because they just want in so bad. But when things are super inflated like that, it's harder to do that. Usually the spreads widen a little bit, so it's more difficult to get in or out of your option in general. So maybe the thing could move, but you just wouldn't be able to do it. Perfect example was GameStop. I'm not talking about when the big moves happened in 2021, but they've had these little jumps here and there. Those were the times that I looked at the option and I thought, man, this is just so inflated. I can't do it. I couldn't even sell because the spread was so terrible that I wasn't able to get a good enough premium percentage in order to make the trade. Like, I want at least a third of the width of the strikes if I'm using an option spread. That's why I like selling puts, because you don't need to worry about that. You can just have the shares as collateral. Calls, you have to do a spread. You can have a margin account and you could short calls naked if you want, and there are people that make good money with that, but that's just way, way too risky. And the amount of capital you need to put up to do that, it's not worth it in my opinion. But with shorting puts, if you absolutely get wiped out on that trade, you at least get some compensation. You get shares. But if you have an option spread, you don't get anything. You just lose the maximum width of the strikes. So if you have a $5 wide spread, you're taking that $500 risk. It goes all the way through it. Well, you've lost 500 minus whatever little premium you took to make that trade. But when you're selling puts, you get the shares. And then what's cool about the shares is you don't have a time limit on those. You can hold those for a while and you can start selling calls on them. So you could actually make money on them while you're waiting. Well, if you just had a spread, well, you don't have anything to show for it. So that's why I like selling puts. That's been my big thing lately. I want to have something, if things go completely upside down, I want to make sure that I have something to be able to regain some of that, because maybe you won't make as much selling calls on those shares as you lost, but you'll at least be able to make something back. Because if you had a spread, it's nothing. You either have to do another spread and hope it wins, or just move on. So having some shares is a great way to protect yourself against stuff like that. So that's what I want to do. I want to sell naked puts if I can. Cash covered puts are the way to go. If you do put spreads, it's the same thing as doing call spreads. You don't have anything to show for it. And the other thing that's terrible about spreads is if it lands in between the strikes, that's the most screwed you can possibly be, because you don't have the protection of the long option and you still are on the hook for the short option. And not to mention, you get more credit. Anytime you do a spread, it's so hard to get more than a third. Like, maybe you'll get half the width if you're lucky. And usually if you do, it means that is not going to be a good trade. Because every time I've done a spread and I've gotten like 50-60% of the width and been like, whoa, this is great, it doesn't work out. I remember I did it on the MJ one time, and I was doing $1 wide spreads, so that would have been $100 risk, and I was getting like $50 to $60 per contract, and I thought, this is great, man. This is going to be so much premium. Well, that didn't work out so well, and I ended up having to, I closed them for a loss. I didn't let it go all the way to expiration and get exercised on those things, but it was not cool. So I don't really like doing that. Anyway, so that's what I've been doing today. I'm looking at the bank stocks. They're Goldman Sachs and Bank of America are reporting on Tuesday, so that's what I'm going to be doing something. on those if I do anything at all. But right now, the last few things I've done were AMC. I sold some puts on those. When it was down here, actually, it had this nice big drop. I sold some puts on it, and man, this just went woo. And I let them go too early. I think I let them go like in here. Once I got this nice big move right here, I think I let it go for a day or two and then dumped it. But it's been, I mean, yeah, no, I let it go in here, actually. I remember because there was the one big one and the second one, and I thought, all right, I'm not going to push my luck getting two nice pumps. And if I had held it all the way until, the last couple of days, that would have been great. But look what's going on today. We're getting this nice drop. Because I was thinking, man, if we get a nice big drop at AMC and the news hasn't changed, I'd consider doing it again because it's such a cheap stock that the max risk is not that much. The good thing about AMC is it has somewhat of a floor because even though theaters are not super profitable right now, they're picking up. They still have some money left that they borrowed, but yeah, now they owe more, so the debt is way worse, and I think that's one of the main reasons why these things are getting crushed. Also, the other thing about AMC is it's offering shares pretty soon. The reason it pumped right here and dumped right here is because they were trying to offer them early, and a court blocked them, and once that happened, it popped back up. So I thought, all right, that's good enough for me. If you sell an option and you get that big of a move, just take your gains, even if it's not all of it. I mean, I could have squeezed another like $30-40 out of each contract if I wanted to, but it wouldn't have mattered. And if I had held and this had come back down, a lot of that stuff would have been lost. Like it looks like it's below where I was when I sold it. So I would have been down right now, even though I would have been up for the past few days. And that's why I say when you get close to your max profit, just take it, because if something like this happens, then you have to wait again. And if this lasts for a while, then it may come all the way back and you might lose money. So like it's the same thing with long options. If you get a nice move, whether you're going long or short, just take your gains. With shares of stock, it's not that big of a deal. You can wait a little bit if you want, if you believe in it long term, like a lot of these AMC people do. They think it's going to be good long term. And it might. I'm not saying it won't. I think, there's something to be said about the theater industry and their ability to pivot as technology comes in, because it's just not the same watching something at home. It really isn't. Like a big blockbuster movie comes, like if they have another, I don't know, Hunger Games or Harry Potter or something like that, then it's just not going to be as fun to watch at home, even if you have a cool theater set up in your house. It's just way better when there's a big audience of people, everybody's laughing with you. So there's something to be said about that. But I don't necessarily think that they're going to be out of trouble anytime soon, because there's just so much debt associated with that industry, and they're going to have to pivot to make more money long term. Competition with your phone and with streaming services is eating into their profits, and it has been for a while now. So anyway, the point was, this was a nice little move. If it comes back down low to this nice little floor here, that's what I was going to say. Okay, so the reason I like AMC and down here is because once it gets this low, it doesn't tend to go much lower than that. Let me back, like you can see this trend. This was meme stock era 2021, and it's just been downhill ever since. But look what happens when it finally did this nice break right here and it sat. It hasn't really gone much lower than the low single digits. If it comes down and you can make some money down here where you're kind of safe, where if you do get exercise, it's not that much. Because look at this. Let's say it goes down to $2 a share and you sold the $2 put. Wow. $200 per contract, big deal. And you'll have 100 shares per contract. So you could have a ton, and then you could flip to the other side and sell calls when things start moving again. Because it's a meme stock, people love to YOLO the calls and puts. That's what I want to do. I don't want to be in the meme stocks with the people writing them. I want to be against them when it looks good to be against them. So like right here, when things were sitting up for a while and it was kind of chilling, that was when I was thinking like, as much as I kind of wish I was still in it because the contracts could have given me a little bit more. I don't like the fact that it's just sitting there for too long. Something like this was bound to happen in a stock that's barely holding itself up in the first place because people just want to get out of it. Like this cascade is being made worse because people are so frustrated with the fact that every time it comes up to these levels, it comes back down. And that's why I want to take my premium when I can and just get out. It wasn't that they weren't going to give share and weren't going to offer shares. It was that they were just being delayed till the time they were supposed to do it anyway. They were trying to do it early so they could make money now, but a court blocked them. So the thing bounced. And the other thing that made me nervous is they were talking about this other shareholder of AMC that dumped like 1 million or a couple million shares. And I thought, man, that's not good. I don't like the fact that it's pumping on somebody selling a bunch of their shares as well. That was like the thing that actually made me get out. I probably would have held it a little bit longer if that news story hadn't also accompanied the other thing, because I thought, all right, we've got CPI data coming up. It's probably going to be okay. We've got reasons for the market to kind of hover for a little bit. I'm okay chilling. But today we've got this nice big volatile day. And part of the reason is because people are assuming that we're going to have another hike, which is likely. So they're thinking like, okay, there's going to be a little bit more pressure. We don't know if this is the end, and there's a lot of people talking about all kinds of bearish stuff like they normally are. So it was a good day for everything to kind of come back a little bit, especially after yesterday's little squeeze. So, okay, that was one more thing. I didn't make as much as AMC, but I did a little scalp on the SPY. So yeah, this day right here, when it came right down, back down here, I thought, okay, this is way out of whack. It pumped because CPI came in pretty well. And I'm expecting that is somewhat bullish. But as it went down, like I was expecting it to do, I decided to get into a call right here and just hold it for like 20, 30, 40 minutes, whatever it was. I let it go. It didn't even get to VWAP. My plan was getting somewhere around VWAP and then getting out. I probably got like halfway to VWAP, maybe 2/3 of the way to VWAP, and then just dumped it because I didn't want to sit there. I was looking at the screen. You know, that's the problem. When you sit there and you look at it, you watch it, every little down tick gets your mind going like, oh God, I don't know. Is this it? Is it coming back down now? And what happened later in the day? The FOMC minutes came out, and it revealed that there's probably going to be another hike. So that was what everybody was scared of, because they thought that maybe with everything that's gone on, there wouldn't be another hike and we would pause this time, which would have been bullish for stocks in the short term. But that's been kind of thrown out the window, because as things are right now, it looks like there's going to be one more. And then we have to say, like, are they going to say that they're going to pause? That's the next thing we're waiting for. If once they say officially that we're going to pause, then there's going to be some elation in the market, which could cause a little bit of a bullish run in the meantime. But since things are softening, the reality of those things is going to bring stuff back down at some point, unless earnings has anything to say. So that's what's important about this earnings season. This earnings season is telling us what we're going to be able to do for the next couple of months, because the next earnings season comes out in 3 months. So we won't know more until then. But in the meantime, there's going to be all these projections, and people are so bearish that it's going to be relatively easy to overcome their projections and pump the market a little bit in the meantime. So, and it's going to be mixed too, because everything is slowing down, there are going to be some businesses that are actually hurt by this whole thing. So I wouldn't be surprised to see a day where certain stocks are flying, but the S&P is just kind of sitting or dropping. That happens a lot when you see these outliers that are doing really well while everybody else is kind of going down a bit. With this kind of volatility, I like this range that I've been saying. So I like to sell options and just kind of collect the premium while it sits in here. And if you look, it is sort of slowly trending upwards from the late half of 2022 up to now. And I kind of expect that to continue over time as long as things stay the way they are and we don't get another Silicon Valley Bank or whatever. If we get something else like that, then all bets are off. But if things kind of stay where they are and the Fed sort of stays on the plan that they've said, because they didn't really change it from the previous time, that could see us slowly drifting back up, because the market is looking out farther in advance than the rest of us are. We're looking at right now, but the market is looking at next year's. You know, next year actually looks a little bit better, then things will start to reflect that now, because people want to get in beforehand. The whole thing with the stock market is you make money by getting into the move before it happens. Unless it's 2021 and Bitcoin's at 64K, you're not going to be able to just buy stocks that are at all-time highs and have it keep going. You know, everybody needs to get in before they're even close to that range. So that's what I'm looking for right now, is I'm looking for things to stay in a range, maybe trend up a little bit as long as the data allows us, because things are softening, but not as quick as you would expect. Just that's why I think it's bullish. Like if things were softening really, really fast, then yeah, I would say, no, we're going lower. But because it's doing it so slowly, it's what the Fed wants. The Fed doesn't want to crash the economy. They don't want people angry at them. They want to keep doing what they're doing. They want to stay in power. So if things don't look good, they're going to get voted out. New people are going to come in because people are going to be mad. That's what politics is. Like, oh, the Fed isn't political. Yes, it is. It's political through indirect channels. It's not directly political because they can't be directly political. It's political through pressures of not just government, but people in general. Because like Jerome Powell wants to stay the chair. He doesn't want to go back to flipping burgers. I mean, not that he was flipping burgers, but he doesn't want to go do something else. You know, he's going to want to sit up there and keep doing what he's doing. So that's about it for the day. I'm going to call it. Hopefully everybody's been having a good trading couple of weeks. I don't know when my next stream is going to be, but I'm going to try to do these a little bit more often during this time and see what comes of it. Check out the Discord. The link is in the description. I'd love to have more people in there talking, discussing trade strategies. We've got a few, but it's still a small community. So come on in, join us, you know, and stay safe, because this is a difficult environment. If you're not collecting premium in a shallow range like this and you're going long on things and you're YOLOing, be careful. This is a rough environment for that. You could still make money because of the mismatch between what people think and what's actually going to happen, but the likelihood of that is much lower than it was in the past. So be careful, and I will talk to you later. Have a good day.